Investing and financing. You could have cash coming in and going out in each one of these three categories, but the statement of cash flows must list them in three separate categories. It's important for investors to know that if your cash went up by some amount, did it go up because of an operating activity, like you actually made a cash sale? Or you collected money from your customers? Or is it because of an investment activity where you paid cash to buy an equipment? That's different. And finally, financing, where you borrow money from a bank. So if you have $100 increase in cash from a transaction, it is important for investors to know whether the 100 came from collecting money from your customers, or it came from, let's say, maybe you sold land. You had a piece of land in your company, you sold it for some money. So maybe you got money that way. Or maybe you got 100 into your cash because you borrowed money from a bank. The implications of these three are different for cash flow, for those who are kind of evaluating the performance of your company. So that is the reason why GAAP requires you in the cash flow statement to categorize the cash receipts and payments into three categories: operating, investing, financing. And that's all we do here. So what we do is we take the first column, the cash column, where every cash in and out is listed, and we simply categorize it in three categories. So if you look at the statement of cash flows here, so we are going to look at all these items in three categories. So I'm going to say that the collecting the client dues of 260, that's part of operating activities. So what's the nature of the activity? That's really what we're asking here. So when $260,000 of cash came in, was it an operating activity, an investing activity, or a financing activity? All right. Expenses, when you pay expenses in cash, that's an operating activity. You pay utilities, you pay salaries. All those are examples of operating activities. Every month you do it. So it's like a regular, repetitive type of thing.
So purchased inventory for cash would be investing?
No, that's also operating. Why? Because inventory has a short lifespan. And you are in the business by buying the supplies, using the supplies on a regular basis. You are not, buying inventory is not the same thing as buying land. Inventory is bought to consume or to sell. So therefore, the life of inventory is very short and it goes straight to the heart of your operations. You will not buy something and call it inventory unless it is directly related to your operations. Right? Okay.
Professor.
Yes.
Why is it important to categorize them in these three categories?
That's what I said. Because it's very important for somebody to understand. Let us say at the end of the year, you show a loss. Supposing the net income shows negative. Right? But your cash balance actually doubled that year. You had a huge influx of cash. Now, if you don't categorize it in these three categories, investors would not know or would not be able to make sense of how is it that you have so much of cash flow sitting, but you don't have any profits. What's going on? Well, maybe the cash flow that you had was because you just simply borrowed money from a bank. Or it is because you're selling away your assets. Maybe you have land and you're disposing of the land and bringing in cash, so your cash balance keeps on going up, but there are no profits to show because your operations are all in doldrums. So therefore, for them to make sense of the income statement and the statement of cash flows, where the cash is showing as increasing, you need to have the categorization, because that's when they will know, oh, okay, that's what happened here. So even though their operations were bad, they got cash inflow by selling assets or borrowing money from banks.
Despite the way you just said, I mean, you said that, and you also said that it was because of GAAP, so it's a law. You have to do it that way, right?
Yeah, but that's the reasoning behind it. I mean, it's not like somebody says that, okay, I like it this way, so everybody do it. It doesn't work that way, right? So they follow due process. So when the FASB makes a rule mandatory, and therefore...
You explain why it's mandatory, but it is a mandatory rule.
Yes, it is. Absolutely. It is a mandatory rule. You have no leeway on this. Every cash flow statement that you're going to see will have the operating, investing, financing separate inside the statement. Yes. Yes, sir.
So I'm going through the transaction analysis examples 1 through 14 to reflect the cash flow that's in this chart. Now, for number 5, prepaid 2-year insurance premium, which is number 10 on the list, it says here prepaid a 2-year insurance premium on January 1st, 2011 in the amount of $50,000. $50,000. Now, how do I know if it's cash or credit? If it doesn't say cash.
Prepaid.
Prepaid, so prepaid.
Usually, that's what I was explaining to somebody. When I use the term pay, I mean, pay always means cash.
Okay.
Yeah.
What does credit mean? Credit?
I'll say on account. Typically, on account means it's credit. You sold on account, meaning that was a credit sale. You bought on account, it was purchased but not paid for.
I just want to make sure the terminology that we're talking about, because here everything says cash, 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 except for that one, which one is clear.
Yeah, that's me. It's not accounting.
Okay.
Just-
No, just because.
Yeah.
So I have a question.
Yeah.
So when there's fraud, if that's mandatory
Uh-huh.
for every company here.
They have to
When
do it.
there's fraud, is it because they omit some transactions in those statements, is that why there's
Ah,
fraudulent activity?
that's a different matter. The fraud is a different matter. You're now talking about cash disappearing,
Right.
right? When cash disappears, then now you may have an internal fraud because some employee is stealing the money. In which case, typically what will happen is that in those cases, it will be considered an operating loss.
Okay.
So let's say cash balance that should be based on your bank account. Let's say you should have, let's say, $50,000 in cash balance, but you only have 42. Right? You should have 50, but you have only 42 when you take a physical, count of the cash. And that $8,000 that has been stolen, hopefully it has been stolen, in that case, it's considered an operating loss. So you would say, operating, you can always name an account and then put it under operating loss.
But it would be reflected on the sheet, is what I'm.
Yes, it will be. It has to be. Because at the end of the year, now that the sheet shows, that's a good point. At the end of the year, the sheet shows that the cash was $290,000, right? So if you take a physical count of cash and it doesn't show 290, then there must be an adjustment made for the difference. And that adjustment will usually go in the operating section. Because these type of losses are part of operating.
Based on what she was asking, was something that has been bothering me since we had class yesterday. I've heard the term cooking the books. Would that be the same thing?
Not cooking, that's not cooking the books. That's outright fraud. Cooking the books is where you start showing things to make your company look good. That's typically what is done by cooking the books. Cooking the books happens when, let us say for example, something that should be an expense, you call it an asset. Now, that means your profits are better. Because you call it an asset, it's not an expense. When something is not an expense, your profits are higher.
That was what HealthSoft was doing, right?
Yeah, that's how you cook the books.
Yeah, HealthSoft.
That's how you cook the books. But you don't want to go there. I mean, now, no, what I'm saying is, there is a reason why I'm saying what I'm saying.
Is that
After the Enron and after the Sarbanes-Oxley, cooking the books is jail time now.
Oh,
I mean, we actually now have CEOs in jail.
What's in date?
Jail. J-A-I-L, jail.
Monopoly.
Okay, now, if you are, I mean, look. What's that? What was that?
She asked what jail was. I said Monopoly.
Yeah. Oh, yeah. Yeah, go to jail. Go directly to jail. Do not pass go. Do not collect $200. Right? So it's one of those things. Okay, there we go. Now, the point is that, previously you could have a defense like, okay, my accountants did it. Not anymore. After Sarbanes-Oxley, there is a signature of the CEO, the Chief Financial Officer, have to go on the accounts. Meaning that they're actually signing, that they understand what is being presented and that they agree that these are the right numbers. And if it turns out to be that there was material falsification and as well as intentional falsification. I mean, it has to be material and intentional. If both happens, people are going to go to jail. I don't know how many of you know this name, Bernard Ebbers, Ebbers. He was the CEO of MCI WorldCom. There was a company called MCI WorldCom. There was a company. Okay, the MCI WorldCom is no longer there. Okay, MCI itself is not there, right? But they had a company called MCI WorldCom. This guy was the CEO of MCI WorldCom. What MCI WorldCom did was they bought telephone lines. I mean, these lines are basically, you know, the virtual lines, right? They bought telephone lines from other companies so that their calls could go through. So basically, and that is based on supply and demand, right? So today everybody wants to make calls, or all MCA customers are trying to call India or something. So MCA needs a lot of lines now for the calls to go through. And let us say AT&T is having a low demand. So what MCA would do, buy the line from AT&T so that the MCA calls go through the AT&T lines, right? So they did, and this is very common practice. This used to be common practice.
That's not illegal.
No, that alone is not illegal.
No.
But the illegality comes later now. So what they did was, you know, the money. So now MCA pays money to AT&T, right? Because they purchased their lines, and so they have to pay money. But why was this money paid? For the calls to go through, right? So you're counting the calls going through as revenue. When customers make the calls, that money MCI is counting as revenue. But what MCI did was, when they paid money to AT&T to buy these lines, they said, oh, these are lines, so they're investment. They are not expenses. So we will call it as an asset and depreciate it. Because it's a line, so it is not an expense, so we will call it like a long-term asset. What long-term? That asset is there only to let those calls go through for that one day. You cannot call it a long-term asset. There's no way to do that. So they should have called it an expense and reported lower profits. Once you call something an expense, your profit is already going down. So they didn't do that. They called it an asset and they said, oh, we will depreciate it. Now, what is the ultimate consequence? Their profits were overstated. And because the profits were overstated, all the senior officers who were paid a bonus based on profits, they all walked away with hefty bonuses. That's cooking the books. So now what happens is, something that should have been treated as an expense was not treated as an expense. It was treated like an asset, something that has a long life. Okay, think about paying a salary to an employee and say, oh, my employees are assets, so I'm going to call this an asset, not an expense. Doesn't work. Accountants don't treat employees as assets. They treat employees as expenses. That's it. The company can say whatever it wants, right? You see CEOs going up and saying, oh, you know, our biggest assets in the company are our employees.
Yeah, no.
Where is in the balance sheet? In the balance sheet, it's not there. It's not an asset.
You're an expense.
Okay, so therefore the salaries that you pay them is an expense. You cannot call it an asset and say, oh, you know, it's an asset, so I'm going to depreciate it or whatever. It doesn't work.
Well, maybe
The same thing here. Sorry?
Say maybe employees are asset, but their earning are expenses.
That's fine. That's all that is fine. But the point is that the management may actually feel that all its employees are assets, but accountants don't buy into all that. They say that, okay, that's an expense right there. So coming back to the MCA WorldCom, calling it an asset means that their profits are overstated, and then because of overstated profits, the bonuses were overstated. So when Mr. Ebbers went, you know, on the witness stand and said, you know what, yes, I understand that this was all a mistake, but I am not a financial guy, my accounting people did it. The jury didn't buy it. They said, you walked away with the bonus anyway. So you benefited from this, so there is no defense that you didn't know what was going on. So as far as I know, 2 years ago, he was still, you know, the guest of the federal government somewhere in Alabama. I'm just telling you. So it is not, no longer can you, the argument, and again, I have nothing against Mr. Ebbers. I keep using this example. God help me if he finds out what I'm doing here. But the point is that, you know, it is not I'm picking on Mr. Ebbers. It's just that I'm saying that you no longer have a defense saying that I'm a CEO, I'm not an accountant, and I didn't know what was going on. That I didn't know what was going on is gone, is out the door. Not anymore. Okay? So the SEC is coming down heavily on fraud and cooking the books, both.
So is the
Mm.
As a CEO, you should have a pretty broad knowledge of what's going on before you can sign off.
See, the rule is exactly as you say. When you put your name to a piece of paper, you better know what is on that piece of paper.
So
It's simple common sense.
You sit down and see and kind of review everything before you sign off.
Yeah, I mean, at least at the major level, I mean, you can say, okay, profits. Okay, you can say that here are things that we have been paying AT&T for all the use of these lines. You're certainly going to get your performance report saying that your capacity was full, so you had to buy capacity from AT&T to get your calls through. So you're supposed to just ask that question: what happened to all that cost? So then the CFO will say, oh no, those are all assets because it's something. So then you know what has happened. And I'm sure there was more than that. I mean, I'm not a lawyer. I'm sure in the actual case, there probably were emails going back and forth on explaining this to him. And he probably said, oh yeah, good for you. I mean, something like that. Who knows? I don't know. I'm sure there was enough evidence of all that. So it's not, I mean, people don't get sent to jail for nothing. So it's there must be something going on.
Is that what?
Not always, I agree.
Is that what happened with Health South? They tried to
Yeah.
seem their revenue was their profits were high.
Yeah.
And so their stocks would be, so they appreciated their stocks,
And it
but they're
wasn't
actually
South,
depreciating.
the healthcare industry?
Huh?
Health South. Health South is a classic example. That's again an Alabama case.
It's a rehab.
So
it's
it's
a rehab
Alabama.
center.
It's
Very
what's
fancy.
Alabama boy?
Professor,
Health South's a good example. Look up, Google Health South, and you will find out what the scandal really was. I agree with you. That's a good example. Yes.
so they did not report it as expenses because it has a negative effect on profit, right?
Yeah. That's what the jury concluded. They said you wanted to show high profits, so you were trying to keep the expenses as little as possible. So since you cannot keep this, you cannot hide this because cash was paid. So you said, okay, the cash was paid to buy an asset rather than an expense.
Right.
So by calling it an asset, you kind of postpone the expensing to a future date through the depreciation process, rather than calling it an expense, which will take care of the whole thing now, right?
Are there rules for governing executive bonuses? Let's say, is there a rule that says if you have to you get paid your bonus based on how high your profit is? Are there rules governing that?
The rules are very company specific. Every company can make its own rules.
Okay.
So some companies may just say no bonuses, everybody gets a salary. In other companies, the president, I mean, I know of at least one, I forget now, but 2-3 years ago it came in the papers. There was this one CEO who basically said, I'll take only a $1 salary.
Wow.
That's it. He said, no way, I'm taking more than that. I'm well compensated through the stocks that I own, and I don't need a salary. Yeah, there are lots of people who are like that. And it is also true in politics. I mean, in politics, you find that in many countries, people who get elected to become say part of the government,
Yes.
if they have family property and they're basically rich from a family income, they will work for a $1 salary. Of course, that's
they
part of
need
politics.
the
So
power
they
and
want to make
connection.
sure that they get popular that way. But whatever it is, I mean, it's not unheard of for people to just forego all bonuses.
I was just trying to figure out why they would report the profit so high. If there were some kind of rule that says, if the profit is that high, then you get this amount of bonus, then that's why they would report all these assets as.
But remember, two things happens when the profits are reported to be high.
Stocks go up.
Typically, one thing is that you may get an immediate benefit in the form of a cash bonus. The other benefit that you have is your stock price goes up. Since you own stock in your company and the stock price goes up, now you're sitting on a ton more money. Because you're a very profitable company, so investors are willing to pay more for your stock. So your stock price is going up, so the value of your stock has increased too. So you get benefits in multiple directions. And again, to just end this conversation, I want to say this. It's not always true that every company wants to show high profits. There are legitimate reasons why a company may want to show low profits in a given year. Think about it.
Pay less taxes.
That's one. Number two, less
Pay
taxes.
less taxes.
to reduce your tax liability, and the second is that you have less demand on dividends.
Yes.
Stockholders, when they see a lot of profits, they demand dividends. They say, where is my share of the profits? So if you dampen the profits a little bit, then the stockholders are not going to get mad and come after you to pay a dividend. Remember, dividend is totally discretionary. The fact that you have a profit doesn't mean the company needs to pay a dividend. So therefore, for a number of other reasons, companies may want to dampen their profit. And sometimes it's just a political cost.
Why is that?
I mean, you don't want to be seen as making, some people call it what is the term they use? Obnoxious profits or something like that. There is a term they use.
An exorbitant amount.
Exorbitant amount. So basically, you get scrutiny from everybody. They say, how come you're so profitable? What's going on? So you don't want that too. So lots of times, it's not always true that you want to see a growth, and a very too high a growth in profits also invites unnecessary attention. Yes.
Is it legal to dampen the profit?
It's not legal at all. But the problem is that it is absolutely not legal.
If you make profit, you have to report it, right?
Yeah, that's the point. I mean,
There's a way in which you report it.
You made an excellent point. You made an excellent point, and that goes to the heart of it. It goes to the heart of it. You, as a businessman, you make business decisions because that's the way you want to make those decisions,
Right.
and you have full right and the ability to do those decisions.
Right.
All you have to do is to turn around and report on the effect of those decisions according to the rules.
Exactly.
But the problem, what happens is that because you want to report something, you work backwards and start changing your decisions based on what is it that you want to report. Now comes other issues. Now you are putting the cart before the horse. And you have gone to the heart of it. That's exactly what it is.
Is that regulated by the SOX, the Southern SOX?
Yeah, of course. But you're not in trouble unless you're caught.
My dad always said.
Not in trouble until you're caught. But again, okay, those are philosophical issues. It's okay, let's get back to it. Okay, guys, the next thing that I want to do, we are now at 8 o'clock, so I'm going to give you an assignment to do here in class, but you can take a break, walk out, get coffee or something, finish the assignment. So I'm going to give you 20 minutes to complete it. So let me, I don't know if it is still there. So